Good morning and Happy New Year. Welcome to the street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Coming up on the show, we'll be joined by our guest co-host, John Zechner, chair and founder of J. Zechner Associates, and later our featured guest, Brianne Gardner of Velocity Investment Partners. Raymond James will give us her market look ahead for 2026. And we want to hear from you this morning on First Call. Reach us with your questions on North American large cap stocks, and we'll have John answer as many of them as he can. The number to call, 1-855-326-6266. And we'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The price of oil is fluctuating on the first trading day of 2026. There are expectations that a supply surplus will offset geopolitical risks to production in several OPEC Plus nations. OPEC Plus is leaning toward caution, with key members expected to reaffirm a decision to pause supply increases during the first quarter. The International Energy Agency has forecasted a glut of about 3.8 million barrels a day for this year. U.S. President Donald Trump has pushed back a tariff increase on some imported goods for a year now. The move will delay a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and vanities. Trump says the move is due to ongoing trade talks. A 25% tariff imposed in September will remain. Shares of Sable Offshore Corporation are surging in pre-market trading after it received the green light to restart a controversial pipeline. Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California, after a federal court ruled against environmental groups. It's the latest win for the oil operation, which has been battered with lawsuits and regulatory scrutiny since ExxonMobil handed over the reins 10 years after the unit was shut down following a massive oil spill. And now our top line story. It's a brand new year, which means brand new possibilities for the markets, especially around interest rates. After a year of cuts and mixed signals from the Fed, what does 2026 hold for policy, inflation, and investors? Let's bring in our guest co-host, John Zechner, to join us now. He's the chair and founder of J. Zechner Associates. John, thanks as always for joining us. Happy New Year to you.
Happy New Year, Roger.
Hopefully you had a good one, and hopefully 2026 looks as good, for the most part, at least markets, as 2025 was.
Starting out okay.
Okay, so where do you see us heading? Let's start first with rates in the U.S. What are your thoughts on it?
You know what, Roger? Rates are becoming, I think, a tougher call. It's really a sort of a ball up in the air right now. It could go both ways, and I've been more inclined to sort of think we'd be hitting lower rates because we'd get some more economic weakness from the tariffs and other things. We're not really seeing that. We're seeing a very resilient North American economy in general. I mean, Canada, because the trade agreements didn't, the tariffs didn't hurt us as much because things that were sort of compliant under USMCA, it didn't apply to. So we've sort of come out of that. And in the U.S., you know, the market's held up better. The consumer has held up somewhat better, only at the high end. And obviously the AI spending has kept, the economy strong. And on top of that, it's sort of pedal to the metal with fiscal policy in both countries. And that's sort of, offsetting any sort of any potential weakness out there. I mean, you look at it. I mean, it's the last 3 administrations in the U.S., quite honestly. The first Trump, and then Biden, and now Trump too, that they've, in peacetime, in non-recessionary times, you're running deficits of 6 to 7% GDP, which is unheard of. So you put all that together, and I think, okay, you sort of got a more resilient economy. You got inflation sticky in this, 3% range. I mean, that last number is a bit of an anomaly, and we're still getting, data because of the data restrictions flowing in. But, inflation really isn't breaking down to the levels where you should get more cuts in interest rates.
Okay.
And, no matter what Donald Trump may try to do with the Federal Reserve Board, I don't know that, he can sort of force them all across the board to get the 6 votes necessary to, push down rates as much as he necessarily wants to. So in the end, what I'm saying is, what, rates may not go in a lot of places right now, and they may not achieve the results. They may stay relatively high because of resilient economy, sticky inflation, and effectively the yield curve structure in the U.S. and the term premium to attract all this deficit financing.
What does that mean? I mean, I've seen that they're talking. The guess is 2 rate cuts for the year, and they probably factored that in for the markets right now. What happens if we don't get those rate cuts? How do you see the markets responding?
Well, funny, Roger. I mean, markets nothing seems to disrupt markets to any large degree. You seem to have this, buying momentum that just continues on because, the rate cuts didn't really come in as much as expected in the past year, in fact. But, I think at a point, given the high valuations, it's a bit of a risk. But on the other side, if the economy continues to tick along as it is, if you don't get any breakdown there, the fact that you're not cutting rates may not matter as much because it means the earnings will still be relatively resilient and in line, and but it'll just maybe shift away from some of the interest sensitive sectors, utilities to a degree that have done well, and even gold, and to more cyclicals. The industrials may keep going, the financials in this environment where you've got higher longer term rates and maybe lower short term rates have done better. So you might see more of that just moving to the real economy, not just tech and not just interest sensitives.
I know, but then today you look at tech and we see tech up, some of them are up 2% and 3% right now.
Well, they're having a nice bounce because they had we got no Santa Claus rally effectively in December, and so they stumbled a little into the year. And tech's had a bit of a tougher run lately compared to what they've had for the last, since the bottom in 2022. So, there's that aspect. But yeah, I would not bet against technology. Certainly at this point, it's an increasing part of the overall economy, and that's not going to slow down, particularly on AI. But I think it's just, where the valuations are extended, there's a little bit more risk. So we're careful where we're picking our spots there. And just the index weight in the U.S. and the passive money flows that worries me a little bit too. But in the end, like I say, it's a tougher call because the resilience of the economy and the stickiness of inflation may disappoint some investors in terms of what they get on cuts, and certainly the expectation for the housing market and others are for more interest rate cuts, and they're not going to get it. In fact, housing is a tougher call. I mean, problem is, even if you cut short-term rates, long-term rates aren't dropping, and long-term rates are what determine mortgage rates. So housing doesn't get the lift, and that's that's what the housing stocks are telling you. That's what lumber is telling you. That's what sort of Home Depot is telling you in their fourth quarter.
And just touching on, you mentioned inflation, 2.7. So there was some data that was missing from that. What do you think is realistic for inflation, and what kind of a role will it play?
I think core inflation is still running around the 3% level, Roger, both, particularly in the U.S. where, it's more important to see, what we're seeing right now in terms of the interest rate moves and then the central bank moves. Because you're right. I mean, there was you took out a core part of the housing index, or the imputed rentals factor, and they assumed it was zero, and they can't assume that's zero. And that's what you got to that 2.7 number. So, we're going to have a lot of revisions for these numbers over the next couple of months, but like I say, it's an odd one. The employment number is an odd one, and no one's really hiring. I mean, you're not adding to the employment levels, but because of lower migration levels and everything, or immigration levels in the U.S., there's not a lot of firing as well because people are a little worried about labor supply. So, it's a lot of things that may in that environment, and that's what some of the Federal Reserve Board members are telling you. It's better just to sit tight and watch and to see how it unfolds.
Okay, well, we're going to take a break right now, but John, thanks as always for joining us. Stick around. That's our guest co-host, John Zechner, chair and founder of J. Zechner Associates. Up next, tech's AI-fueled rally faces new questions as cracks emerge in the mega cap trade. What does this mean for the markets in 2026? We'll get more into that after the break. Let's see how things are shaping up on the markets. We'll start with U.S. futures, and technology stocks are leading the way right now. You can see the Nasdaq's up by almost a point. Let's kind of a little mini Santa Claus rally. We still have today and Monday as part of the Santa Claus rally, so maybe we'll call it a mini Santa Claus rally right now. You can see the Dow also up by 0.37, S&P 500 up by 0.54. Heading over to Asia. Let's see what they're doing there. You can see the Nikkei was closed for the holidays, but the Hang Seng up 2.76%. Tech stocks there fueling it as well. CSI 300, they're off by 0.46. Heading over to Europe, rallies to start the new year. The FTSE topping 10,000 for the first time in intraday trading. It's back down below 10, but still up 0.41%. The CAC 40 and DAX also surging as well. CAC 40 up by 0.36. German DAX up by 0.34. Let's see if the TSX can follow suit today after another down day on Wednesday, half day of trading. Gold, silver, and other material stocks dragging down the TSX on the final day of 2025, but still finished up about 28% for the year. So who were some of the winners and losers on a Wednesday? Energy Fuels up 2.16%. G Mining Venture up by about 1.5%. Endeavor Silver off by 3.87%. And Aya Gold and Silver down by about 3. And taking a look at the metals, they are all in the green. Another volatile day for silver. It's up 4.5%, 4.4% roughly, 73.70, but it's been all over the board. Gold hovering in record territory, up by 1.61% at more than 4,400 again. And copper is up slightly for the day. It's up 0.75% at 572. And oil now, and still struggle for oil. It was a rough year, and Western Canadian Select closed down by 1.28%. And south of the border, similar situation, back below 57 for WTI, off by, right now it's off by 0.87%. Okay, tech stocks soared in 2025 on AI hype, but cracks are starting to show from NVIDIA's dominance to Oracle's warning signs. We are forced to ask ourselves, is the AI trade entering a new phase? For more, let's bring back our guest co-host, John Zechner, chair and founder of J. Zechner Associates. John, we touched on it briefly in our first chat. Tech stocks bouncing back today, having a good day, but overall, still lots of questions.
Yeah, there really are. Sort of a tagline I sort of like. If NVIDIA is the coal mine of artificial intelligence, is Oracle the canary in it? And that's sort of what I want, because that's really been the whistleblower on some of the valuations and the stories in the past quarter in particular. It's almost like we're talking about an interest rates as well, Roger. I mean, there's a lot at stake here, and it sort of could go either way. We know technology will continue to grow. We know it's an increasing part of the economy. AI will ultimately, is going to change productivity and improve the economy, apparently massively. And we've seen all the indications from that. My issue is a little bit you're paying for so much of it today. And anytime you pay for something that has not happened yet, at an accelerated rate or a higher rate, you have inflated risk effectively, because if it happens, well, it's happened and we were paying for it already, so it doesn't go much higher. If it doesn't happen, there's a lot of downside to it. And that's why I get a little queasy about, the valuations and just the bullishness around the story. And like people say, it's not the same as 2000 because they're better companies, they're more resilient and all of that. Absolutely true. But I'm starting to see a few things that remind me a little of 2000-ish. I mean, the one is this Oracle's, what kept Oracle going. Like I say, that's why the canary in the coal mine really started lifting in September to those massive gains was, they are becoming the sort of the AI cloud in their data centers. And that's sort of and they had sort of great contracts from OpenAI, but they're not really revenue contracts. They're not backlog. They're what they call RPOs, or remaining performance obligations, which is a sort of an indication or almost a promise that at some point we will generate these revenues. And they're sort of can't put them on the balance sheet, but they're putting them in the financial statements and the releases. And that's what's driving a lot of the growth. And, that reminds me a little of, remember back in 2000, this is the eyeballs test and things like that. I thought you need something real. I mean, the combined spending of the Mag 7 last year, or the hyperscalers, with basically $400 billion on AI infrastructure and AI rollout. You start doing it over multiple years, you've got trillions of dollars invested. To get any sort of normalized return on equity or return on investment on this amount, you need hundreds of billions of dollars worth of improvements in productivity. And maybe it'll come. And I listen to both sides of the arguments. Roger, I haven't seen it yet. A little from Missouri, a little of a skeptical on that. Like, I started my business in the 90s, the early 90s, and it was the age of the internet. And at that point, I mean, it had a massive impact on how, when it's how you do spreadsheets. You started networking. You could sort of relate that within your client base, within, who you could talk to. And then there was a huge improvement in efficiency. I mean, ChatGPT and Gemini, I find them, interesting, and I use them, but I have yet to see that massive productivity increase. And others tell me, no, it's coming and it's going to be huge. But we're paying for it already.
What might be some triggers for you in 2026 that would really have you thinking?
Well, I just think maybe a slowdown by some of the hyperscalers in their spending might indicate that maybe demand isn't exactly where they expected it to be, or not a continual increase in that. That would be a bit of a headwind. But for the technology sector, general, Roger, my way to play is, why don't we play the stuff that is assuming the negative impact of AI? And it's gotten overly beaten up. I mean, the software companies, everyone assumes that AI is going to bypass the need for application software. I don't think companies are going to restructure, their entire back rooms and their entire application systems and everything else, on a whim or immediately. And yet these stocks are sort of being priced. You'll get, Salesforce and Adobe and Workday and ServiceNow and all of this. They've been, stocks have been, put under a lot of pressure. Look at Constellation Software up here. I mean, I'd rather kick the tires on those at lower valuations than to chase some of the, the high flyers like the Oracles and the Palantirs of the world that are really, I think, have all the optimism of AI built into them already.
But isn't there dangers, though, with looking at the ones you're looking at, that if AI does come true, they actually will be obsolete almost?
Absolutely, but it's almost a counter of the argument that I use I hate paying up for something that hasn't happened yet on the expectation that it will. On the same thing, when stocks get punished for a negative outcome that may or may not happen. Well, what's your downside? If it happens the way we're expecting, well, the stock's already trading at, look at Adobe trading at, 15 times forward earnings. I mean, there's probably not that much downside risk from that. So, I'd rather, but that's more I sort of more of a value orientation in that regard. So that's what I tend to do is, look for some of the laggards where there's too much pessimism about, the negative impact of AI on these companies. But, on the other side, yeah, there's the, healthcare will be a beneficiary, telecom will be a beneficiary. We see lots of it. I just want to see more concrete examples of it, and I think the market may get impatient at a point that there's a lot of talk, but let's deliver something.
All right, we're going to have to wrap it up there for now, John. But stick around. I know you're coming back. John Zechner will be back with why Sprott Uranium Trust could surge in 2026. That's next. Well, time to see what's on the radar for John Zechner, chair and founder of J. Zechner Associates. John, thanks as always for joining us. And you're liking Sprott Physical Uranium Trust because of everything that's unfolding when it comes to the data centers?
Absolutely. This is the old Uranium Participation Corp, which is you only really pure play on the commodity itself, on uranium itself. And I just think, we've all been playing, Cameco and the growth there, and then the other people building up the data centers and nuclear expansion. I mean, Atkins Realis, Constellation Energy in the US. And, there's so many names have been associated with this trade and going higher. And the expectation obviously is you're going to have massive nuclear expansion over the next decade. And that will be needed to feed the electricity needs from AI. if all of this is going to happen, you know what? Uranium will not be at $80 a pound.
Hmm.
And I just think, because the cost of production right now is probably for anybody, for new starters, going to be well over $100 a pound. And effectively right now, you don't, they've been running off inventories for decades in uranium because it's all, the de-enrichment from the nuclear weapons back into the 80s and 90s when they started taking out and they started de-enriching uranium. There was so much excess supply for a long period of time. Annual production of uranium really doesn't meet the annual demand. Demand is growing. So, the only way to get production going is prices higher to attract that. And I just think, there's just not, and you look at some of the geopolitical reaches of the world that are larger, producers outside of Canada, and they're risky areas as well in the former Soviet Union. So add it all together, and I thought, you know what, uranium has to go higher than $80 a pound, and the purest play on that right now is this sprott physical uranium, the
Hmm.
old uranium participation. All they do is they own uranium, and so it's a direct play on the commodity, just like GLD is a play on gold. So I think the price has got to go higher.
Now, but if you're talking, I mean, a lot of these, the plants, the small facilities, modular facilities, if they're up to 10 years out, is this not getting in a little too early?
Well, the thing is, I mean, ultimately, because you're right. I mean, the thing everyone talks about the contracting, the building, and the building takes a period of time, and sort of the last thing in the process is contracting the uranium. And so you're right. It may not immediately pop, but that's the direction it has to go in because they're going to need it. You need the feedstock in the end in order to run them. So it's just like I say, you can't do it without the uranium, and you won't get that supply you need, especially in a higher demand level at the current price. So the price has got to go higher, and seems the cleanest way to play it. And if if it's not going to go higher, I think there's more risk in a Cameco trading at 35 times operating cash flow than there is in owning the commodity directly.
Okay, let's move on. We touched briefly on it in our last chat. Adobe, you still like it? You still think there's a place for it?
Yeah, I like I say, the application software, I think with the rumors of its death are exaggerated. Effectively, I think companies aren't going to be ripping out their, internal systems and moving away from these. I looked at Adobe's last quarter. You got a company trading at 15 times forward earnings, still growing at better than 10%. People still use obviously Acrobat and all the variations of it. So I don't think AI will displace the application software to the degree that maybe the market is expecting right now. These stocks have underperformed for a period of time, and I just find it a pretty good valuation and pretty good story right now.
Do you think Adobe can adopt to AI?
Well, they are. They're implementing it, and they can add models to it. Same way Microsoft is doing it with with their system with Copilot and other things like that. That I find a bit of an irritation on a spreadsheet right now because I don't want it. But yeah, they will make themselves part of the application software as well. That you've got an AI engine within that. So yeah, the idea that you're going to change it dramatically overnight, I think it'll be a slow migration to it. In the meantime, it's a cheaper way to play the ongoing growth.
Okay, we're going to take a break right now, but John, stick around. As we head into 2026, markets face big questions. We'll break down what's driving sentiment and where opportunities may lie. Also, our phone lines will be open for our first call segment, the first of 2026. You can reach us at 1-855-326-6266. You can also email us at firstcall@bellmedia.ca. The price of oil is fluctuating on the first trading day of 2026. There are expectations that a supply surplus will offset geopolitical risks to production in several OPEC Plus nations. OPEC Plus is leaning toward caution, with key members expected to reaffirm a decision to pause supply increases during the first quarter. The International Energy Agency has forecast a glut of about 3.8 million barrels a day for this year. Denison Mines is ready to begin constructing its uranium mine in Saskatchewan. The Canadian uranium company says once it receives final government approvals, it will be poised to begin producing uranium at the site by mid-2028. The project is set to become Canada's first major new uranium mine since Cigar Lake. Edison warns, however, that total costs for the project are now estimated to be 20% higher at more than $500 million due to inflation and increases in expenses. The price of aluminum climbed above $3,000 US a ton for the first time in more than 3 years. The jump is due to a cap on Chinese smelting capacity as well as constraints to European production due to higher electricity prices. Both have chipped away at global inventories. The demand outlook from the construction and renewable sectors are also contributing factors. And taking a look at the U.S. futures, nice way to start off the year. You can see they are trending upward right now. The Dow up by 0.3, the Nasdaq by 0.95, and the S&P 500 up by a half point. Okay, the champagne bottles are empty. The glitter's been cleaned up. We've welcomed in the new year. Time to get back to work and see what we can expect for the U.S. and Canadian markets for 2026. Here to talk about her predictions is Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. Brianne, thank you as always for joining us. Happy New Year.
Happy New Year to you too.
Okay, so you've got a blank sheet ahead of you. Let's start large caps. Where are you seeing them go?
Yeah, I think for us, when we look ahead into 2026 and headed into this year now, the big question is really whether the US or Canada leads. And our view is that we see the S&P 500 likely having a little bit of an edge, but with a few important caveats. I'd say most street forecasts right now, analysts are predicting the index climbing again this year. We're seeing some targets across the street as high as 7,500 to 8,000, driven by earnings and the tech sector leadership continuing to pull it higher. I think, base case, we do expect 8 to 10% from the S&P 500 right in line with its long-term kind of average return. Bull case, you see a bit of a melt up and we see another double-digit year. I think the U.S. economy is entering 2026 still in really great shape, right? We've seen GDP and retail sales are still showing no signs of a slowdown yet, and commodities have had one of the best runs in decades, and we really think it will continue to be one of the leaders again this year. So that said, I still prefer a diversified portfolio that can generate, alpha by tactically positioning so that if a sector volatility hits, and we do expect 2026 to be quite a volatile year, especially with midterms coming up, the portfolios that, will see a little bit less of a downside. So we are continuing to expand across different sectors and geographically as well.
And is that we've been spoiled the last 3 years, double-digit plus returns. Could that be a factor? People expecting something like that again? Could that play into it? Emotion?
Yeah, I think one thing that we're watching that's continuing to drive markets higher is really earnings, right? In the US, earnings are still doing the heavy lifting. The S&P 500 profit margins are expected to be near 14% again in 2026. So again, still double-digit growth out of a lot of these large cap companies, and that's well above long-term averages. And so when we're seeing that type of profit margins well above that, that keeps the earnings story intact. Revenue and earnings should see double-digit year over year. In Canada, the TSX can still do well, but leadership likely to shift, and the Canadian long-term returns are typically slightly lower than in the US, which is expected to continue to see that this year as well. There will be a few, I think, areas to make money. And while commodity prices will help the materials sector, demand for quality, income should support dividend payers and diversification rather than kind of chasing that rapid, growth story still. So I think volatility is, again, going to be something we expect more this year, a little bit more muted going through 2025. We only had that one double-digit correction mainly. So not a crisis level volatility, but I do think more frequent rotations between sectors, style, and regions. And as a market reacts to these earnings numbers that are coming out, interest rates continuing to come down and trade related influences on corporate America, again, I think that we will see a strong year through 2026, but could be a little bit challenging to start.
All right, John, you want to jump in?
Yeah. Hey, Brianne, Happy New Year. You got to get, we have quite a winter up here. You got to get up here, get on the hills with us.
Hi, John. Happy New Year to you.
Roger and I were chatting a lot about the tech stocks already, and I'm sort of curious, where are you playing? I mean, everybody's sort of in tech, but I think the big thing is, what parts of it. So what are you looking at both here and in the US and within the tech sector?
Yeah, I think from a sector perspective, we did see tech, continuously lead 2025 and have a strong, earnings and returns for this past year. But I don't think it's going to be the tech sector alone that is going to continue to carry the markets. With, historically, the tech sector, it does tend to be one of the strongest ones. And there's usually more help from communications, industrials, consumer discretionary, so to say. In Canada, 70% of the performance of the TSX came solely by materials and financials. And those two will likely continue to be kind of the top half again. So yes, I still think earnings are projected to be in the tech sector double-digit growth. And can these large cap names continue to do well? I think, again, the AI story, if we're specifically going in there, I think it's going to be a little bit more broadening out as we're getting more companies who are getting into the space, developing more, and not just on the chip story, but more on, how is this going to be sustainable in the long run, and what sectors are going to continue to benefit from that. So that's certainly all things that we are looking at in the tech space. And I think, with that in mind, we still like U.S. tech names given corporate investments and productivity gains. Utilities, especially tied to rising power demand, is going to be a big one. And I think, too, healthcare, has been an underlying story where valuations are attractive and earnings have still remained resilient in that space. Okay. So I do think we're going to start seeing utilities kind of pick up there, too.
Okay, Brianne, we're going to have to wrap it up there, but thanks as always for joining us. Appreciate it.
Thank you for having me.
Brianne Gardner is Senior Wealth Manager at Velocity Investment Partners, Raymond James. Still ahead, today's market drivers with Bloomberg's Divya Balji, and our phone lines are open. John Zechner is taking your questions on North American large caps. Call us at 1-855-326-6266. You can email us as well, first call at bellmedia.ca. The Free Trade and Labor Mobility in Canada Act comes into effect in 2026, changing how provinces exchange goods and workers. CTV's Jeremy Sherrill has more.
It's a promise the Prime Minister made often in 2025.
So we're building one Canadian economy.
A pledge to remove barriers to interprovincial trade announced last year that today came into effect. Bill C-5, the Free Trade and Labor Mobility in Canada Act, now means provincial requirements for goods and services and workers' licenses will be recognized federally too.
I think symbolically, it's a really good way to start off the year. Actual impact, I think it's really more the provinces than the feds that we're looking for action from.
A separate mutual recognition agreement signed by all provinces and the feds is set to be implemented by June. It will further impact interprovincial trade, but still, experts say some key goods are excluded and still face challenges.
Alcohol, right? Beer, wine, spirits is one example, right, that we hear a lot about. And so there are still ongoing conversations at the provincial level to make it easier to move those goods across borders.
While 2025 saw governments across the board push to trade more within the country, several bilateral agreements were signed between provinces. Experts say 2026 needs to be about follow-through.
There needs to be tangible action on the ground this year, and it needs to come quickly because the Kuzma threat is hanging over all of us.
On the international front, the stakes couldn't be higher. Canada's free trade agreement with the U.S. and Mexico is up for review this year, only putting more pressure on bolstering the domestic economy.
I think it's fundamental to our ability to respond to the threat from the United States, from the tariffs, which probably aren't going to go away soon, even though we have the possibility of a review of the CUSMA.
Formal talks are set to get underway in the coming weeks ahead of a July deadline, when a decision will have to be made on whether to extend the deal as is negotiate a new one, or either country could decide to walk away.
All right, CTV's Jeremy Sharon. For a look at some early market movers, we are joined now by Bloomberg's Divya Balji. She is the managing editor for Breaking News in the Americas. And Divya, Happy New Year to you, and Happy New Year for Wayfair.
Yeah, Happy New Year for a whole bunch of furniture stocks, I guess you could say that. So essentially what Trump has done is, they've put out a fact sheet saying that they are delaying additional tariffs on upholstered furniture, on kitchen cabinets, on vanities as well. Now, if they had kept it the way they were supposed to, those additional tariffs were supposed to take effect on Thursday. Now they've pushed it back a whole year, and they're pushing it back to January 1st, 2027. Now, obviously, that's great news. Companies like you mentioned, Wayfair, RH are all up. There's a whole bunch of other companies as well that we're keeping an eye on for regular trading, since we're in pre-market trading right now. I think the other question here is, are we going to see more of these, from the White House this year, with the expectations that interest rates might go down? Is it possible that they will also delay any additional tariffs that they have threatened? Could they pull back some of the tariffs that they have? I think a lot of this is, something that the market will be paying close attention to for 2026.
I would guarantee the one thing that Donald Trump can sometimes bring is uncertainty. So who knows what will happen in 2026 with all this. Ray J resuming coverage of Apple at a hold equivalent.
Yeah, that's right. Market perform rating. I don't think this is a stock that you can, earnestly come in and put a buy rating on at this point if you're starting coverage or resuming coverage. Ray J in particular is talking about how these technology upgrades that we would expect to see from a company like Apple are not going to be as big, or are going to be as few and far between going forward. And that's why they're putting themselves on the sidelines at this point. Apple has had its fair share of concerns in 2025. Going into 2026, is it somehow going to get more involved in AI? The iPhone 17 was a huge part of its sales for 2025. But what's next for 2026? I think that's really why there's a little bit of cautious optimism with that hold equivalent rating from Raymond James.
And the last one we want to talk about here is Baidu. It plans to list its AI chip units. Some big changes.
Yeah. I found this one quite interesting, not surprising. I think they have sort of televised this to the market in the past, but still interesting from the perspective of this is how you create value in the current environment that we're in. So much money is going towards AI companies in terms of investments, AI stocks. We've obviously talked a lot about the AI bubble here. Now Baidu's coming in and thinking of, essentially spinning off its AI unit and putting it on the Hong Kong Stock Exchange. Hopefully soon. They've already filed their proposal with the Hong Kong Stock Exchange. There is no details on the amount of money or what they're hoping to raise here. There is an analyst that has come out putting the AI units valuation between $16 billion and $23 billion. What that means in terms of how much they will raise is another question altogether, but still a pretty clever way to raise money. This company will still remain a subsidiary of Baidu, but again, a good way to raise money by listing it in a current environment where everybody wants to invest in AI.
That's quite the big swing in the valuation, though, isn't it? That's covering your bases by the looks of it, too.
Absolutely. I mean, that's a great way, to come out and say, here's what we're thinking of doing. Here's what we think our valuation should be. We still don't know that number yet, but at least when you see it, what analysts are calling it at, it's a great way for you to figure out what you're going to sell in terms of shares and what pricing you're going to put on it.
Okay, we'll leave it there, Divya. Thanks as always. Bloomberg's Divya Balji.
Thank you.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including an upgrade for ASML. All right, let's take a look at some notable analyst calls and recommendations. Kicking things off, ASML was upgraded to a buy from a sell by Alethea Capital with a price target of US $1,500. The firm citing they are bullish on the company's EUV outlook. And sticking with upgrades, Barclays raising its rating for Vertiv Holdings to overweight with a price target of US 200, citing higher earnings estimates and a revised valuation following recent share price volatility. And finally, Jefferies has initiated coverage of Algoma Steel with a hold and a price target of $6. The firm suggested there is an implicit call option in Algoma shares if a new North American trade agreement in steel materializes, which Jefferies believes is likely at some point. When we come back, John Zechner will take your questions on First Call. Time for our first call of 2026. We're going to start, though, with an email. It's from Greg. Is the runway to higher stock prices still in place, as this sector is called highly cyclical? What inning of the game are we in on Micron shares price escalation? John.
Yeah, you know what? That's a tough call. I mean, I kicked myself a Micron. It's a little story. I bought this one last year when in the sell-off around $60. So we've always played the memory market, and that's the best way to play the memory market. And I think it went to 100, and pat ourselves on the back and sold it. And then I watched it go to almost 300. I thought, holy, my thing is, memory is always like. Semiconductors are cyclical anyway, and memory is the most cyclical part of that market. So Micron over the years is just these boom bust cycles that, you get the pricing running high, and then suddenly, new capacity comes in and prices just crash. And so if you look like a, 20 or 30-year history of this stock, and you'll see it. But this most recent run seems to have more legs, and it's always been one of the cheaper ones in the sector. And, maybe the memory requirements of all this data center expansion is bigger than any of us realize, and there really are only two big players globally in memory, and there's Micron and Samsung, and Micron probably has a more competitive advantage there. So I'm after having sold it when I did, and it's not as cheap as it was, I'm a little loath to chase it here. And like I say, it's a very cyclical play. It always has been, but it seems to have momentum. So bottom line, like I say, I can't see owning it near the $300 level, but there's some people who believe that there's, still upside in memory.
Okay. We'll move on now. It's an email from Sal. Is Torex still a buy, or should I wait for some correction?
You know what? I like the golds in general, and I think you've got to continue to keep a weighting in gold in your portfolio. So it's a matter of the names. And, I'm getting a little nervous about some of the geopolitical risks of West Africa and a few places like that. And that, we've taken some of those names like B2 Gold and some of off the portfolio. Torex just sticks out like a big win. Everybody talks about, Agnico in Canada, and I agree. I like Agnico, but Torex, this Morales property in Mexico. I mean, it was really, the stock was trading so cheap, and because of the El Limon mine was sort of coming to the end of its useful life. But what they've been able to do is they've migrated to the Media Luna, which is another deposit on the same property, and replaced effectively all that production. They've gone underground as well as Media Luna, as well as at the old Limon, and they've been able to extend the reserves into the mid-2030s at this point, and the thing's still trading at a discount to net asset value, and it's trading about 5 times operating cash flow. So yeah, I like the sector, and this to me is a cheap play. And in Mexico, geopolitically, that's a safe region. Like, come on, compared to some of the other ones in the world where you see mining, whether it's in Venezuela, parts of Argentina, Chile's more stable, but certainly a lot of big mines in West Africa, and look what Barrick went through in Mali in the past year. So a play like this, I think, sticks out as a good one.
Okay, let's move on now. An email from John, and it says, "Good morning. Will MDA recover in 2026?"
Well, this is one of the expectations seem to be that there's a lot of risk in it because they lost the EchoStar contract, and then there's some worries they're going to lose the Globalstar contract as well, which I don't know if that happened. I mean, Globalstar is really Apple, and Apple, I think is more going for the direct to handset satellite to handset sort of model, which a lot are going for right now. So I think MDA will continue to get that business. Plus, I mean, the initiatives in Canada alone, announced by the Carney government in this past budget, really showing more spending domestically on things like space, on infrastructure, technology, and MDA is at the center of all of that. So yeah, I think the stocks, had a tougher year after a fantastic run for a number of years, and we've been back buying it into this low 20s, and your risk is maybe something negative happens with the Global Star contract, but in the absence of that, I think there's plenty of growth going forward, and it's a decent industry, different place, and there are no similar plays like this in Canada, and not that many, quite honestly, internationally.
Okay. Squeezing in some more emails here. Excuse me, my voice is going for a second. This one's from Kevin. Please comment on ARM stock. Should I buy, hold, or sell?
Within the chip sector, and we've been reducing our chip exposure generally, because I talked about it with Micron. I mean, they go through boom bust cycles, and maybe the demand for data centers will continue, indefinitely. But I want to reduce the risk. Having said that, ARM is more of a consolidator in the sector. They got broader exposures, and the valuation is a little bit lower. So if I kind of leave a name on, if you owned it, I'd probably continue to hold it as a hedge in the sector. To have some, maybe even a reduced weight, but I'm less, I'm a little more concerned about the valuation and the cyclicality is not appreciated within chips, because ultimately new supply comes on and prices, come down dramatically. So I don't, I've got worries about the sector in general. ARM's not at the top of my list on that basis, but they're all starting to underperform lately. So, and
what are some of the concerns?
Just oversupply. I mean, what the demand is growing over long periods of time, but you're sort of increasing your supply slowly. Once you do, then prices start to come down, and the story has been margins. And when prices come down a little bit, I mean, margins in the sector right now are running, 70%.
I got to cut John. I got to cut you off there. Sorry.
Right, Roger,
thanks as always. Happy New Year, John. Always a pleasure to have you on the street. Though that's it for us, John Zechner. The Open is next. The markets will open about 30 minutes from now. Have a great day.